In the last decade, Europe's real estate landscape has quietly made room for a new kind of investor. The micro-equity holder, the small lender, the retail participant who owns a slice of a student housing block in Tallinn or a co-working conversion in Lisbon, not by buying property outright but by pooling capital online with dozens, hundreds, or thousands of others via real estate crowdfunding platforms. What began as a fintech experiment has matured into an ecosystem shaped by regulation, institutional interest, technological innovations such as tokenization, and hard lessons about due diligence and alignment of incentives, and understanding that arc is the aim of this long-form analysis presented as a single continuous narrative so readers can sit with the whole picture, the promise and the potholes, in one uninterrupted flow. Real estate crowdfunding's appeal is straightforward. It democratizes access to an asset class that traditionally required large capital, specialized knowledge, or both, allowing investors to diversify across projects, geographies and risk profiles with much smaller check sizes. Retail investors can back debt-style loans secured by bricks and mortar with fixed coupon returns or buy equity shares in development projects that promise higher upside in exchange for longer lockups and greater risk. And hybrid models in between proliferate. Loan-based, peer-to-peer debt, equity-based, and revenue-sharing structures each come with their own risk, return profile and operational mechanics, and savvy investors choose not simply by headline yield but by understanding underlying cash flows, sponsor track record, exit timing, and platform alignment. Behind the scenes of this democratization sits a regulatory scaffolding that matters more than many first-time investors realize. The European Union enacted Regulation EU 2020-15/03, commonly called the European Crowdfunding Service Providers Regulation, or ECSPR, to create an EU-wide framework for crowdfunding service providers, harmonizing authorization, investor protection disclosures and cross-border passporting so platforms can scale across member states while subjects like competent authorities and ESMA coordinate oversight. That regulation, together with subsequent implementing technical standards, has been a turning point because it reduced legal fragmentation and set common minimum standards for transparency and operational controls, which in turn changed how platforms design products and present risk to investors. The market numbers are still forming, but they are meaningful. Aggregated reports and market surveys estimate that real estate crowdfunding, as part of the broader crowdfunding market, has grown materially in recent years, and figures published by research groups suggest the global connected pool of real estate crowdfunding capital reached tens of billions of euros by the early months of 2025, with reputable industry trackers estimating cumulative resources raised in the sector at figures north of 50 billion euros when combining regions and product types. Independent market research firms project robust growth through the rest of the decade, forecasting double-digit compound annual growth rates for segments within Europe as institutional interest and technological innovation drive scale, though as always macro conditions and liquidity cycles will modulate the realized outcomes. To translate numbers into human choices, why now? Low interest rate eras and regulatory openness drew a wave of retail participants searching for yield following the great financial crisis and again after subsequent market dislocations. Meanwhile, real estate developers and sponsors, especially small and mid-sized ones without traditional bank relationships, are seeking speed and flexibility, found crowdfunding a viable way to access project finance while pre-testing demand, and platforms vertically integrated services such as underwriting, escrow, KYC, ongoing reporting and secondary marketplaces to make participation easier, albeit not risk-free. The practical architecture of deals is diverse. Typical debt deals offer secured first or second ranking mortgages or hypothecs, specified loan-to-value (LTV) caps, amortization schedules or bullet repayments at exit, and covenants designed to protect lenders, while equity deals subdivide ownership and distribute profits via dividends or sale proceeds, sometimes with waterfall priorities that give senior investors first claim on returns. Many platforms supplement deal pages with scenario models, sensitivity analyses, and a risk grade. Yet the quality and granularity of those disclosures vary widely, so investors must look past attractive IRR projections and read sponsor track records, independent valuations, exit assumptions, and contingency plans for delays, cost overruns, and market downturns. If one were to sketch a buyer's journey, it goes something like this. The investor signs up, completes KYC and a suitability test, scans curated opportunities filtered by geography, sector, residential, commercial, logistics, Hospitality, asset vintage, new development versus refurbishment versus stabilized asset, investment vehicle, SPV shares, bonds, notes, tokenized security, evaluates the sponsor and the numbers, checks projected timelines and exit routes, and then deploys capital either directly into a single deal or via pooled funds and portfolios offered by some platforms. After the investment is live, regular reporting, distributions and, in some cases, secondary trading options are the visible parts of post-investment servicing. But the journey also contains pitfalls: liquidity constraints, project risk, platform operational risk, sponsor misalignment, valuation subjectivity, and concentration risks, geographic or sponsor-specific, have all caused losses and reputational shocks for platforms and investors alike in European markets. Recent industry audits and commentaries have documented legal actions and investor complaints tied to underperforming projects or platform failures, underscoring that while crowdfunding lowers capital barriers, it does not eliminate the need for rigorous underwriting and risk management. The regulatory context. Returning briefly to that theme because it is decisive for scale and trust, matters in two ways. First, harmonized EU rules like ECSPR set baseline protections and enable cross-border offerings which expand the investor base for a project beyond domestic savers to a pan-European pool. Second, national competent authorities implement and supervise platforms, and certain countries provide particularly fertile ecosystems because of favorable taxation, strong property markets, or supportive fintech policy. The Central Bank of Ireland, for example, and other national regulators or active competent authorities that have issued guidance and frameworks for crowdfunding providers operating under ECSPR, and their scrutiny affects platform licensing, reporting, and consumer protection measures. Those two regulatory levers, harmonization and supervision, explain why some pan-European platforms emerged earlier than others and why platform consolidation and professionalization picked up pace. Early movers that successfully built compliance programs, robust risk teams, and diversified deal pipelines were able to attract not only retail investors but also family offices and, increasingly, institutional capital seeking access to niche real estate exposures with better fee economics or more flexible terms than direct large-ticket acquisitions. Institutional interest itself is a watershed for the sector because it brings scale, more sophisticated underwriting, and a tolerance for longer lockups that can stabilize returns. Several industry commentators in 2024-2025 noted a steady uptick in institutional allocations to crowdfunding vehicles and tokenized real estate products, which suggests the sector may be moving beyond hobbyist retail allocations to a complementary channel used by professional money managers. Yet this maturation does not mean homogeneity. Variety is the sector's current strength. In Europe you'll find platforms that emphasize short-term, high-yield bridging loans for refurbishments. Others package long-term rental cash flows, build-to-let or buy-to-let portfolios aimed at income investors. Some focus on residential condo pre-sales, some on niche asset classes like student housing, logistics hubs, last-mile warehouses, data centers or hospitality, and a new frontier is tokenized real estate where ownership rights or income streams are represented by digital securities that can, theoretically, be traded 24/7 on compliant venues. Tokenization promises fractional ownership with programmability, automatic dividends, embedded transfer restrictions, smart escrow, and potentially greater liquidity via secondary marketplaces, but it also raises questions about custody, regulatory qualification of tokens as securities, and how traditional property rights map onto blockchain records, so the hype must be separated from legal and operational reality before investors treat tokenized offerings as a simple liquidity shortcut. Across all these models, platform economics and alignment with sponsors shape outcomes. Platforms that co-invest alongside retail users and take lower fees on exit typically demonstrate better long-term alignment than those that treat originations purely as fee opportunities. Likewise, transparent related party disclosures and independent valuation practices reduce conflict risk. To paint this in human terms, consider a hypothetical small investor in Europe. Call her Sarah, who enters a platform with €1,000 and splits it across 10 deals to diversify. Her portfolio might include a short-term 12-month bridge loan in Spain paying 8-10% nominal, an equity stake in a Lisbon co-living conversion with a projected IRR of 15-20% over 3 to 5 years, and a stabilized German rental portfolio offering modest yield but promising capital preservation. Sarah's returns will depend on realized cash flows, Currency impacts if she invests across Euro and non-Euro zones, tax treatment in her home jurisdiction, platform fees, and whether exit assumptions hold. If developers miss deadlines, rents fall, or refinancing markets tighten, the short-term loans may be rolled into extensions or suffer write-downs, and the equity deals may see deferred exits or lower sale proceeds, outcomes that are common enough to be central to any sober analysis. What makes Sarah's situation different from older forms of property investment is the granularity and transparency that some platforms offer, good, and the potential for rapid diversification and smaller ticket sizes, also good, but these advantages coexist with operational risk of platforms, imperfect secondary markets for selling stakes, and the concentration of sponsor risk across projects originated by the same developer. Case studies from European platforms show both success stories and cautionary tales. Platforms that carefully underwrote projects, used independent valuers, and maintained conservative LTVs produced steady returns and low default rates. Platforms that prioritized growth and high yield without commensurate underwriting controls faced borrower defaults, project delays, and regulatory scrutiny. That led to investor losses and diminished brand trust. For investors and platform operators, the lessons are similar to classic credit and real estate investing. Know your counterparty. Demand skin in the game from sponsors, insist on third-party valuations, and stress test exit assumptions against downside scenarios including interest rate shocks and localized market slumps. One must also address the behavioral side of crowdfunding, which shapes outcomes. Retail investors can be herded by attractive sell sheet headlines into chasing yield with insufficient diversification, a phenomenon amplified by gamified UX, push notifications about hot deals, and social proof. Industry trade groups and some platforms now emphasize investor education and suitability assessments to mitigate this risk, but effective mitigation is uneven across the ecosystem. Another pragmatic axis for analysis is geography. Europe is not a single market for property, and the liquidity, regulation, and return dynamics differ between core markets Germany, France, UK pre-Brexit adjustments, and peripheral or emerging markets Baltics, Central and Eastern Europe, Iberia, where yields may be higher but legal protections and market depth vary. Savvy underwriting therefore blends local market intelligence with portfolio control to avoid concentrated exposures to single economic cycles or regulatory regimes. Platform selection becomes a principal skill for investors. Historical performance, default and recovery rates, transparency of reporting, strength of governance, existence of buyback or guarantee mechanisms, availability of secondary markets, and the platform's capital structure. Do they have a balance sheet cushion? All matter. Notable European platforms that rose to prominence differ by model and jurisdiction. Some emphasize crowdlending to real estate developers, others favor equity stakes in completed or developing assets, and a few provide white label services to banks and investment funds. For retail investors, reviewing independent reviews and regulatory status authorized under ECSPR where applicable, or supervised domestically should be a first step in vetting. Looking forward, 3 structural trends will shape whether real estate crowdfunding becomes a sustained mainstream channel or remains a niche adjunct to traditional real estate finance. 1. Regulatory evolution and convergence. Whether the ECSPR is reviewed to raise funding caps or expand asset class treatment, and how national regulators harmonize enforcement. 2. Institutional participation and product maturation. If pensions, insurance companies, and asset managers allocate material capital, platforms will professionalize further and diligence standards will rise. And 3. Technological integration, tokenization, better secondary market infrastructure, and data-driven underwriting using alternative data could lower friction and improve pricing while also introducing new operational risks. Recent dialogues within the EU about raising caps and modernizing rules for digital securities suggest the regulator's stance is not static, and active policy review may make crowdfunding more attractive to larger investors over time. But to be candid about the downside, because any long-form analysis must do so, there are systemic risks and single-platform failure scenarios to consider. Market concentration, where too much capital follows a few high-profile sponsors, can amplify losses if a localized property downturn occurs. Liquidity mismatches between long-dated development projects and retail investors' desire for tradability can cause forced discounts on secondary markets, and operational lapses at platforms in underwriting, escrow, or reporting can inflict losses even when the underlying real estate fundamentals remain intact. Moreover, the intersection of debt crowdfunding and rising interest rates can create stress where developers face refinancing pressures, making conservative LTVs and realistic exit assumptions non-negotiable in underwriting. Recent industry reporting and regulatory reviews have highlighted legal actions against platforms and investor complaints tied to failed or misrepresented projects, a reminder that regulatory design and enforcement are not theoretical but consequential to investor outcomes. For the curious investor wanting to participate responsibly, a practical checklist distilled from industry best practices is useful. A. Start with platform due diligence. Verify authorization and local competent authority oversight. Examine historical default recovery rates and read independent reviews. B. Read every deal's documentation. Understand the SPV structure, security type mortgage, pledge, equity priority waterfall, fees, and exit mechanics. C. Check sponsor track records and ask for proof of co-investment. Sponsors who invest alongside retail participants have more aligned incentives. D. Diversify across sponsors, geographies, and asset types. Small tickets across many deals reduce idiosyncratic risk. E. Model downside scenarios, assume lower rents, higher vacancies, or delayed exits and see how those outcomes affect returns. F. Be clear on tax treatment and reporting obligations in your home country. And G. Monitor platform governance, independent boards, clear conflicts of interest disclosures and insurance backstop arrangements increase resilience. If one is institutionally minded, look for platforms that provide institutional-grade reporting, escrowed client funds, audited accounts, and clearly mapped legal rights in the SPV documentation. These features indicate readiness to handle larger pools of capital. The investor story in Europe also has a social and economic dimension. By enabling smaller investors to fund housing, adaptive reuse and local developments, crowdfunding can channel private capital toward projects that may otherwise lack financing, from affordable housing refurbishments to community redevelopment projects, thereby aligning investor returns with social impact goals, provided the platform's impact claims are measurable and verified. In the same vein, policymakers view well-regulated crowdfunding as a tool to unlock alternative finance for SMEs and property entrepreneurs, and that policy framing affects how platforms position deals to retail audiences. Finally, while this analysis has emphasized fundamentals, process and prudence, the future also contains speculative possibilities. If tokenized property securities achieve legal clarity and interoperable secondary markets emerge, the liquidity premium that retail investors currently pay could shrink and new types of hybrid instruments could coexist with plain vanilla debt and equity offerings. Conversely, if regulatory fragmentation or macroeconomic shocks tighten capital and increase defaults, the sector could contract, repurpose, and return to a slower, more conservative growth path. For now, the verdict is nuanced. Real estate crowdfunding in Europe has moved beyond novelty to become a legitimate channel for certain investor types and project sponsors, supported by regulatory frameworks such as ECSPR that enable cross-border scale and provide minimum investor protections, while still demanding careful due diligence, attention to platform quality and governance, and realistic expectations about liquidity and project risk. The promise is real: democratized access, diversified exposure, and participation in local real estate opportunity, but so are the responsibilities. Platforms must keep improving underwriting, transparency, and investor education. Regulators must enforce rules consistently and adapt to innovation like tokenization, and investors must trade smartphone convenience for old-fashioned homework. For those willing to invest the time to learn, real estate crowdfunding offers a new route into property exposure with exciting possibilities for portfolio construction. For those seeking a quick shortcut to high yields without scrutiny, the market will eventually exact its price. In that balance between opportunity and caution lies the essence of the new age trend. Not every investor should, or will, participate, but those who do with discipline, diversified allocation, and an eye to governance may find that crowdfunding becomes a durable part of a modern European real estate investor's toolkit, complementing direct ownership, funds, and institutional channels while expanding access to property-backed returns across borders and generations.